Welcome to the second part of this course on financial independence for women. If you have not watched the first part, kindly watch it before you proceed with this second part. In order to bring in financial support and stability in your life, there are a few compulsory things that needs to be done irrespective of your current financial position and status. In the next couple of slides, let us go through them. The first compulsory thing that needs to be done is to buy a term insurance for the financial protection of your family. Note that this is not a life insurance which is used as investment, but it is a risk cover in the form of term insurance that is provided to the beneficiary in the case of death of the insured. So any loss of breadwinner, death of breadwinner or severe physical disability can bring in a lot of financial instability in the family. Term insurance provides a protection against that. The beneficiary of the term insurance can use this money to manage many family needs such as the education of your children, marriage of your children, repayment of debts or other exigencies. If you are a working woman, you may buy it, and if you are a homemaker, you better pester your spouse to buy it because it gives you peace and stability when it comes to the finances of the family. The premiums are very affordable. Say a middle-aged person of 30 years can get the term insurance of INR 1 crore for a premium of 1000 to 1500 per month. Premiums here are usually not refunded because this is a risk cover and not an investment option. Here is where many families do not go for this insurance, calculating the amount of money that they have to shell out over a period of time. If you calculate the absolute amount of money, say that you will pay 1000 rupees per month, over 12 months it will be 12,000, and over 10 years it will be 1,20,000 rupees. You may not get into it thinking that it is a lot of money going out and you are not getting anything, but the risk cover provided is a huge financial support, and therefore you need to look at the peace of mind and financial stability it offers and not the monthly outgoing premium. Also, there are a variety of plans available now wherein they also guarantee the return of premium, but this would ideally have a higher premium. The lower premium ones, which are very affordable, also guarantees a significant sum of money. You can buy this insurance from any company. Some of the most preferred ones are HDFC and ICICI, but a variety of companies offer term insurance, and you need to compulsorily have it for your family till the time when the children get educated and they start working and earning on their own. The second compulsory thing to do is to buy the medical insurance policy for the health and safety of your family. Most of you would be aware of this, and many of you would be covered by your office policy along with your family and parents. However, in the case where you need to buy additional insurance for yourself, or because your parents are not covered in your policy, or because you are not covered by your office, then you need to look into the following points before you can go ahead and buy a medical insurance policy. The recommendation here is to read the key features thoroughly before buying the policy. Do not blindly subscribe to any medical insurance policy just because the advertisement claims that they are offering it at a very low premium. What are the things that you need to see? One is the coverage of illness, including critical illness. A lot of medical policies exclude a variety of critical illness, and therefore you need to see what type of illness is covered or not covered under the policy. Also, the insurance policies prescribe a waiting period of 24 to 48 months, and they do not cover the existing illness. Therefore, it is always advisable to continue with the same insurer for a longer period of time in order to cover your existing illness also in the coming years. The insurance policies also provide for replenishment of the insurance amount, both limited and unlimited. You will be able to use that amount multiple times within the same year for the same premium, and this is a significant benefit. Kindly look out for replenishment of the insurance amount once it is exhausted in the policy. There is also a no claim bonus. No claim bonus, previously they used to provide it as a reduction from premium, but now most of the companies add it as a part of the insurance amount. So in the subsequent years, if you have bought the insurance policy, check whether the no claim bonus equivalent amount of insurance value is added to your insurance policy. Also look at the type of hospitals covered and whether cashless hospitalization is offered in most of these hospitals. One of the key things that you need to check before you subscribe to a medical insurance policy is the cash settlement ratio. This provides an overview of how many claims have been successfully settled. The higher the percentage, the better for you, because this gives an indication that the insurance company has honored the medical claims lodged in by the people. So the two compulsory things that you need to do, one is to get the term insurance done, and the second is to do the medical insurance for your entire family, given the kind of expenses that we incur in hospitals. The next compulsory thing to do is to bring in a load of common sense into your investment decisions. Analyze all your investment decisions by simple mathematics and comparing it with the bank FD return. By simply investing in a bank FD, you can earn interest up to 6 to 7%. Any other investments that you are making, compare it with the low risk bank interest and see whether it is offering you additional return for the risk taken and whether the risk taken is worthwhile. I see a lot of people buying into the schemes where a company offers you a stream of pension every month from the age of your retirement, say from 60 to 75 years. If you deposit some monthly amount when you are in your 40s, so they ask you to deposit money for 10 years and then they guarantee that they will pay you your pensions from 60 to 75 or 60 to 80. Please note that in the slide of inflation, we learned that inflation is going to eat into your money and savings, and therefore if somebody is promising you 10 lakh rupees after 20 years, the value of the same would be very small today, or with the 10 lakh after 20-30 years, you will be hardly be able to buy anything. In all such schemes, you need to see if I had kept this money in the bank account, how much I would have earned as a low risk return from bank FD versus what they are offering, and only when it is significantly and substantially higher should you invest it, and not blindly because they are offering you pension month on month post your retirement. Any scheme which offers you more than 15% return or promises you 15% of return in a year has to be viewed with caution and reviewed thoroughly before investing. Earning a 15% return is not easy in any kind of business, and therefore your caution should be at the forefront before investing into any returns which is 15% and above. Note that high returns always involve high risk and there is no possibility of an easy return. So if someone is promising you easy money without any risk, then stay away. The higher the return, there will always be higher risk. There are no schemes or investment opportunities in the world that can double or triple your money in a very short term. All such schemes are a scam, and all such schemes where they say that some Nigerian prince has given them money and if you pay their taxes they will give you thousands of crores, or the schemes where they say that RBI has their thousands of crores stuck in RBI and if you clear the taxes they are going to pay you this money, or where they promise you in cryptocurrency will double your money in a couple of weeks, or in NFT they are going to double your money. All such schemes are scams. There are no such schemes in the world. The best schemes in the world can offer you 10 to 15% return, or if you yourself try in a variety of stock market or other things you may get a higher return, but anything which promises are a double or triple, immediately use your common sense and say no to all such schemes. Do not invest in any scheme because your friend or relative told you so, irrespective of how attractive it is and what returns are promised. Please develop your own knowledge and the ability to evaluate the scheme before you start investing. And last but not the least, never invest with borrowed money. That can completely kill you because you have to pay interest on the borrowed money. And if God forbidden, if there is a severe loss with the investments that you have made, you will be in trouble from both sides. So before any investment decisions, please use your basic common sense, and that will really help you to decide on your investments. Let us now jump into the various investment opportunities that you can explore. All these investments can be done online from the comfort of your home, and you just need a computer and a network connection. You do not have to depend on anyone or hand over your money to anyone to invest in these schemes. You may not understand all of it at one go, so please come back and read and hear the slides again for a couple of times before you get a hang of it. The first scheme that we will talk about in the low risk area is that of RBI floating rate taxable bonds. The name sounds very complex, but in simple terms, government is borrowing money from you, and for that they are offering you an interest. These bonds are issued and backed by central government and RBI, and therefore they are very safe investments. The bonds are held in electronic format, not physical format. To hold them in electronic format, you need a demat account. In a few minutes, we'll talk what demat account is. The present interest rate for these bonds are at 7.35%, marginally higher compared to your FD interest rates, and this can help you match the average inflation rates that prevail in the country. So the value of your money will not go down but will be compensated by this interest. The interest rates are floating rate interest. It can change once in a quarter. The government can either take it down or take it up, but they usually keep a good rate of interest for the bonds issued by RBI. Interest is paid half yearly, can change from time to time, and is taxable. You just need a minimum investment of 1000 rupees to get into this, and you can go up to any amount that you want to invest. These investments are non-liquid investments because there is a maturity period or locking period of 7 years. You cannot transfer these bonds to anybody, and neither you can withdraw it before the maturity period. You need to wait for 7 years to get the amount invested. You need to look at these investments only if you are trying to invest for the longer time period, because in the case of FDs, if you get the money back within a year or two, you may spend the money elsewhere. But you do not want to touch the money, earn a good rate of interest, and want to invest for a longer period of time, which is also a safe investment. Then you need to look at RBI bonds. It can be invested online, and it needs a demat account for investment. Demat account is nothing but, in simple terms, it is a short form for conversion of physical assets into electronic assets. Instead of having a physical copy of the bond, you will have it in the form of an electronic format, which is called as the dematerialization. And to have it in electronic format, you need a separate account called a demat account. And this demat account, you can open it through many service providers who are called as the depository participants or DPs. Some of the well-known depository participants or DPs are ICICI Direct, HDFC Bank, Kotak Securities, and there are a variety of DPs who do it. It is preferable for safety purposes you go with one of the recognized nationalized bank which is offering these services. Many women make investment in jewelry or gold coins or bars for future requirement or for use in marriages. While investing in gold coins and bars are a reasonable choice, investing in jewelry for future needs is not a good option. Buy jewelry only for personal consumption and not as an investment for future use, as they do not carry any high resale value. Almost 25 to 35% of the value of the jewelry will be lost in the form of purity and other charges. One of the alternate low risk investments that you can look at in the area of gold is that of sovereign gold bonds or SGB. SGBs are issued by central government and RBI periodically, and therefore it is a very safe investment to make. The issue rate is based on the gold rate on the date of issue for a 24 karat gold, and it is offered with a small discount. You need to minimum invest or subscribe for 25 grams, and there is a lock-in period of 8 years. Though there is a lock-in period of 8 years, the sovereign gold bonds are tradable on the market, and therefore it can be sold on any day on the market, making it liquid. You don't need to compulsorily hold it for 8-year period. The additional incentive for going to this bond versus buying a gold bar or gold coin is that you will also get 2.5% interest per annum. So if you had bought physical gold bar or coin, you would have got only the appreciation in the value of gold. Here you will not only get the appreciation in the value of the gold, but you will also get an additional 2.5% interest. So with a 2.5% interest per annum plus say a 5% increase in the value of the gold per year, total 7.5% will be a good amount for you to at least match the inflation or beat it to a little extent. The gold bond will be held in a demat form, so therefore it takes away all the other disadvantages that you will have by holding the gold bond in a physical format, where you need to prevent it from theft and take care of it. Those kind of needs will be done away with. Not only is your gold bond secure in a demat format, it also earns you an additional 2.5% interest. So with the same demat account online, you can make these purchases whenever the RBI and the government releases this periodically. It is a very safe alternate form of investment that you can look at, which you can invest for a longer period of time and exchange it as and when the need occurs in future. Now let us move into the medium risk territory. The first investment option that we will look at here are the corporate FDs. All of you are aware of and have experienced the bank FDs. Similar to bank FDs, many companies and corporate issue FDs at a higher rate of interest compared to the bank FD interest rate. The interest rate in corporate FDs are usually in the range of 6.5 to 8.5%, and they are offered for a period of 1 to 5 years. Higher the period of investment, higher is the rate of interest that you will get, and the interest you can either take it cumulatively along with the principal, or you can take it quarterly, half yearly, or on an annual basis. The bank FDs are usually considered very safe because they to an extent have the backing of the government. In the case of corporate FDs, the safety of the investment depends on the reputation of the bank, the financial stability of that company, and the rating offered to that investment instrument by the credit rating agencies. Usually look out for a AAA rating on that instrument, which would have a very minimum risk of investment. Risk is there, but the risk would be minimum for a AAA rated investment. If you are a new investor, do not go for any investment below AAA, as that would be considered unsafe. But if you have had some experience with the investment, you can go up to a single A, but definitely not below that. The minimum investment that would be required is from the range of usually around 5,000 to 25,000, and the same demat account that you would have opened for other investment can also be used to buy this investment and hold the investment in an electronic format. This investment offers a higher rate of interest compared to bank FDs. It will at least try to save the tax amount that you would have to pay on your interest earning by giving you a higher return compared to the bank FDs. The next investment alternative that we will look at in minimum risk area is the invoice discounting investment. These are investments which are picking up pace, and many investors are interested in this. I will briefly explain the concept to you. Largely it works this way, but in practice there could be certain variations and alterations. Say company A issues invoice to company B and company B has to make the payment for this invoice to company A. Company B gets a credit period of 90 days and therefore company B will make the payment to company A only after 90 days. However, company A cannot wait for 90 days as it has requirement for money immediately for business operations. Company A then approaches company C and asks it to make the payment towards the invoice against the payment of certain charges or interest to company C. So what company C does? Company C pays 90% of the invoice value to company A and the balance amount is paid after certain deductions. Now company C would also needs the funds and amount to pay the money to company A. Therefore, company C now takes the role of an intermediary and approaches the individual customers like you and me to finance the payment to be made to company A. In summary, the short of all this is company C collects money from individual customers to make the payment to company A and in return gives interest in the range of 11 to 13.5%. Now why this interest rate is high? Because if company A had gone to a bank to get a working capital loan to run its business, the interest it would have paid would have been much higher. Therefore, for company A, this is a better option of financing its requirements. The investment period are also shorter. Your investments will be returned to you along with the interest within 45, 60 or 90 days. You don't need to wait for long periods of time to get your investment back. The investment range is also limited in terms of you don't need to shell in very high money. From 25,000 to 3 lakh you can make the investment into invoice discounting model. Interest is also paid if there is any delay in return of your investment beyond a specified date. Now while this looks attractive on the face of it, it has a lot of inherent risk here. The one single risk is the company B may default and it may never pay the money to company A. Company A may default to company C, it may not pay them the required interest or the promised returns, and then company C may default to the individual customers like you and me because they have not received money from A, they may not return the money to you. There are many inherent risks in this, but most of the companies involved in this are reputed companies and you need to test this investment by investing small amounts of money and withdrawing your investments after it is returned with interest in 45 days and 60 days or 60-90 days, and then based on your comfort level you need to increase the size of your investment, but at no point in time risk big amount of money into this. While reputed companies are involved, always there are high risk in this. There are a lot of agreements and contracts to back it up and reduce and minimize the risk, but still the risk is inherent in this. Carefully tread the path with minimum investments and then you can increase it, but this is very attractive investments. There are many companies like Credex.com or Finsight Ventures which offer these services. You can log into their website and check out this. The next investment alternative under medium risk investment for discussion is the non-convertible debentures. Don't be carried away by the use of a heavy term non-convertible debentures. In simple terms, the company or a corporate is borrowing money from you and for that is paying you interest. Non-convertible debentures or NCDs are very similar to corporate FDs, just that in the case of NCD the interest rates are much higher, anywhere between 8.5% to 10%. Higher the period of investment, higher would be the interest rate. And unlike corporate FDs, the NCDs are listed on the stock market and therefore you have an option to trade, that is you have an option to sell the NCDs and exit from the same, therefore making it a very liquid type of investment. If there is increase in the value of NCDs, you can sell it and exit from the market, or if you wish to hold it and earn interest, you could do that as well. The risk profile of NCDs is dependent on the reputation of the corporate, the financial stability of the corporate and the credit ratings accorded to the instrument or the NCD. If you are a new investor, kindly look out for a AAA credit rating which is of minimum risk. The rating is given based on the financials of the corporate, its reputation and its previous track record on issue of NCDs and payment of interest. So a AAA rated instrument will be reasonably safe. If you are a new investor, please prefer to stay with AAA rated NCDs. The minimum investments range anywhere from 50,000 to 1 lakh rupees, and similar to your corporate FDs, even NCDs can be held in the demat form. Again, when you invest in NCDs, irrespective of what the rating is and how big a rating has been provided, please look into the reputation of the company before investing in this. Investing into any kind of NCDs can give you a loss if the company goes bust. All said and done, compared to a variety of investment, NCDs offer good returns and is of medium risk. The other medium risk investment opportunity that you can explore is that of the gold exchange traded fund or gold ETF. Again, don't be flustered with the use of heavy term called gold exchange traded fund. The finance people have a tendency to give fancy names to simple things. In very simple terms, gold ETF is like buying gold in an electronic form. Gold ETF is very similar to the SGB or the sovereign gold bond that we saw, but with some differences. In sovereign gold bond, you get a 2.5% interest because it is backed by the government. In gold ETF, you would not get any interest as these are issued by many private banks. The gold ETF is traded like a share or a stock on the stock market, and the price of the ETF will be tracking the price of the gold. So if there is an increase in the price of the gold, you will be benefited. If there is a decrease, there will be a loss, but you can hold the gold ETF just like the stock of any of the company and trade it at your convenience. The gold ETF can be purchased and held in the demat form similar to any of the other instruments. The other significant advantage of gold ETF is that you can buy as minimum as 1 gram and hold it, as against a sovereign gold bond where you need to invest at least in 25 grams. This is also beneficial for people who are interested in investing in gold but do not want to hold them in the form of jewelry or in the form of gold bars or gold coins. There will be no transaction tax and other taxes or other cost associated with the physical gold. This can be bought electronically and sold electronically, and therefore offering the benefits of not holding it in a physical format. The next investment for discussion under the medium risk alternative is the National Pension Scheme or NPS. NPS is a voluntary retirement savings scheme introduced by the central government with the objective that every Indian citizen should have a retirement corpus. The scheme is available to everybody in the age bracket of 18 to 60 years and is modeled into two buckets. Bucket 1 or the tier 1 contains the corpus which is non-withdrawable and permanent in nature, and the money in tier 1 you will be able to get only after the retirement in the prescribed way. There is a second bucket called tier 2 where the amount you have invested along with the returns that you have earned is withdrawable subject to the condition that you have also subscribed to tier 1. How does this National Pension Scheme works? There is a minimum investment of 1000 rupees per month in tier 1 and there is no minimum investment requirement in tier 2. The amount that you would have invested in tier 1 and tier 2 is provided to an investment fund. Usually the investment funds that I have seen in this are supported by SBI and the Kotak Bank. These investment funds collect your money that you have contributed and then invest it into various stocks and debt instruments. You may see that because it is a retirement fund, they are not going to put entire 100% of your money into stocks because that would be risky. So therefore they are going to put both into stocks and debt instruments which offer fixed rate of return. So in a balanced portfolio, they invest your money. Usually what is observed is the average rate of return is between 9% to 11% based on my experience. This is good enough to beat the inflation and also leave you with some surplus. As discussed, tier 2 can be withdrawn and therefore it is liquid. Tier 1 is illiquid. NPS contribution is also attractive to working people because it offers an income tax deduction up to an investment of INR 1.5 lakhs, plus there is a additional deduction that is eligible for INR 50,000. Tier 1 can be withdrawn partially for events like children's marriage. There are very few exceptions carved out and when tier 1 can be withdrawn. One of the event is a children's marriage, else you can withdraw tier 1 only in a phased manner after attaining the retirement of 60 years. NPS scheme is somewhat similar to mutual fund scheme where you will give the money to mutual funds and then they invest it, but this is well regulated, controlled by the regulatory authorities, and your investment is spread across both stocks and debt, so therefore making it medium risk. And in the past the returns have also been good, offering a much higher rate of return than your bank FDs or a corporate FDs, and therefore this is one of the preferred options of investment and also builds a retirement corpus for you. You can avail the NPS scheme either through your trading account and demat account that you would have opened with the bank, or you can also open the account with the NPS website itself and operate it. In the previous slides, we have discussed the possible alternate options for investment in the low risk and medium risk areas. Now, through the demat and trading account that I have with a bank, I will show you how all of this investment can be accessed at a single place and everything can be done online. The first one you will see here is the RBI floating rate bond. This is listed here. This will be permanently listed here and it offers a 7.35% interest at a minimum of 1000 rupees investment. Once you have this account and the fund in your account, you can go into the RBI and select the amount of money that you want to invest and you can proceed with the investment. So it is a simple activity. You don't need to have any significant knowledge or you don't need to go to a number of places or submit any document. Once you have your demat and trading account and once you have your money for investment in it, you can go about doing the investments yourself. The second one that we talked about is the sovereign gold bond. Right now it is not listed here, sovereign gold bond. The new sovereign gold bond offering is not listed. The government will list it from time to time. However, there are other earlier listed gold bonds that are available. But if you are new to this field of investment, kindly wait for the new offerings to come in and then you can invest it through online here. The other type of investments that we saw was the investment into corporate FD. The account lists the various corporate FDs that are available. As we discussed, they offer a high rate of interest. The period is usually between 1 to 5 years and with a very small minimum deposit you can enter into it and invest into the corporate FDs. Again, the mechanism is very simple. You don't need any high-end knowledge to invest in this. You just need to have the account and money and then you can go fill in the details and do the investment yourself. We also discussed about the NCDs or non-convertible debentures. Right now high-end or high value amounts NCDs are listed here, but there are a variety of new offerings that keep coming in. And you can invest as small as 50,000 to 1 lakh rupees in that. If you can see, usually the interest rates offered are pretty high and attractive, and based on the ratings that is published, you can do the investment. If you can see here, you can find the ratings here at the bottom of the description. See here the AAAs that you can see. Here is a AA plus, AA plus. If you are a new investor, please go with only AAA bonds which have minimum risk. So once you get your demat account and trading account, all these investments can be managed at a single place. You can also apart from the other investment that we saw, you can also invest in the national pension scheme from the same account. You will have to subscribe to the tier 1 and tier 2 and make the contribution. Your amounts will be given to the pension fund managers who will invest the amount into a variety of stocks and debt instruments. The next investment for discussion under the medium risk alternative is that of the real estate. As most of you would have already got into the real estate area, I will not spend time on how it works and what you should do, but I will spend some time on some of the caution points in real estate, especially the house property. The emotional tangent towards owning a house is very high among women. Therefore, if you want to invest in a house, invest in one good residential property for your self-occupation and use. In the event, if you want to make further investment in the real estate sector or the house property sector, kindly go through these caution points and evaluate the investment thoroughly before investing. The first point is real estate market is very cyclical. There will be a long run of appreciation followed by equally long period of stagnation in the value of the prices. So if you have used borrowed money to buy the house property, then you would be coughing up interest over a long period of time without getting compensatory appreciation in the market value of the asset. The appreciation in the value of the asset is largely dependent on the location and the demand and supply. Therefore, even if it is expensive, it may be worthwhile to invest in an area which has the potential to growth than to invest in remote areas of the city which does not have any potential to growth. So we'll end up paying a small price for it, but even after years the area remains stagnated and does not grow. So therefore picking up the location is very critical. High value investments in apartment would be worth only for self use because resale values are market dependent, and if you have invested borrowing money, the interest would have added up and therefore your resale value expectation would be significantly higher, which the market may not offer at all points in time, and it would be difficult for you to dispose of these apartments. So therefore any high value investment in apartment, do it only for your self use and consumption. Apartments are also bought by people to letting it out on rent, but the rent yields in India are very low because you will have maintenance and repairs activity and also property taxes that you will have to pay. After deducting everything, the rent return that you will get will be very low compared to any of the other instruments that you could have invested in. The only benefit is if you get a significant capital appreciation. So never buy the property only for the rent. The rent will not compensate or give a good return on investment. Title verification is very critical and non-negotiable. Do not buy any property without a thorough title verification. Do not invest based on your relatives or friend investing in it. Please engage the help of a professional person to review the title of the property. And last but not the least, owning multiple real estate property or buying apartments as a creation of asset for children may not be a good idea because the children may never use it. They may settle in different parts of the world and you may not really get the appreciation in the value when you actually want to dispose and use it for something else. It would be better to keep the other financial assets for children than to give an apartment or other kind of house properties. The first investment for discussion under the high risk area is the investment in the stock market. Most people fear stock market, and many people who burnt their fingers in the stock market never return to the stock market. The fear is largely created by lack of knowledge and because of inadequate investment of time to learn the stock market. While stock market is definitely risky and ruthless, with adequate knowledge you can benefit from the stock market. The investment in stock market can be broadly classified into three categories. One is investments into equity, that is buying and selling the shares of the companies. Second is investment in mutual funds, where the third party will collect money from you and invest on your behalf. And the third is derivatives, which is made up of futures and options. Investment in shares and stocks can be either be made for the growth of the price of the stock or to earn dividends. Say if you are investing for growth, if you have bought these shares for 100 and the price goes to 200, then you can sell and encash the difference as profit, or you can stay invested for a longer period of time and earn the annual dividends that are declared by the company. Usually investments in blue chip companies and index fund can offer you good returns over the long run. Good returns in the sense, on an average, the stock market will eventually return to you 12% to around 15%. Only in a few cases you can see very exorbitant return. For a smaller short-term period, you may have exorbitant returns at times, but on an average over the long run, you can expect 12 to 15% return from the stock market. So it is not a place for miracles to happen. It is a place where you can, with good knowledge and good investment, can earn consistently higher return versus the inflation. You should venture into the stock market only if you can invest for a longer period of time and you are not averse or afraid to losing some amount of money. Stock market is not a short-term game. It is for the game for the one who has patience. As Warren Buffett, one of the greatest investors, has said, stock market is a place where the money passes from the impatient to the patient. So if you are patient enough and not afraid of losing some amount of money, only then you venture into the market. Irrespective of your risk profile, irrespective of the kind of amount of money you have, please never invest based on tips offered by somebody or based on some anonymous messages received or based on the fact that your friends or relatives are investing in something. Please spend adequate time and effort to read some of the financial parameters of the company before investing. While there are hundreds of financial parameters that can be checked, you will have to check some key 5 to 7 parameters at least for you to decide whether the stock is good enough for you to invest. Some of the key parameters that you should be able to read and understand are the sales and sales growth, the profit that is made by the company, earning per share, dividend per share, price earning ratio, and peer company price earning ratio. So these are some of the financial metrics which you should be able to read. These are not rocket science. These are pretty simple and easy to read. Anybody who can spend enough time and effort will be able to understand this. And once you are able to understand these parameters and are able to apply this to the stock price, only then you get into the investments in equity. This course or this slide will not be enough to explain all the financial parameters in detail. If anybody wants to learn this in greater detail, please post the same in the comment section. Once I have some adequate number of people for that, I will conduct a webinar or post another video which will cover these aspects on how to read these financial parameters in the statement of the companies. The next investment for discussion under the high risk alternative is that of mutual fund. Many of you would have already had exposure to mutual fund, and those of you who do not want to enter the stock market directly have invested money through mutual funds. In the risk profile slide, I have based the mutual fund in the medium risk block. Here I have put it in high risk in order to show you some of the inherent risk in the mutual fund. Mutual fund in simple terms is nothing but money collected from customers by the mutual fund managers to invest the money into stock or shares and to fixed interest bearing instruments or other instruments. So instead of the customer directly investing the money in stock market, it is invested by the mutual fund company. Mutual funds are operated by managers who have expertise in investment, and therefore they may be able to make better decisions than an individual customer who is not well versed with the market. A good mutual fund can give you returns in the range of 15 to 20%. While this seems very attractive and the various advertisement campaign also makes it attractive that mutual fund sahi hai, there are a lot of risk inherent in mutual fund. One is that mutual funds are managed by companies and organizations which has to pay its staff and to run the operation, and therefore mutual funds come with an entry and exit load. These entry and exit load are the charges on the customer who is investing, and it can be in the range of 2 to 3%. So out of the 15% return that you will make, the entry and exit load will already eat 2 to 3% of your investment. The second risk is the mutual fund growth is primarily depend on the type of stocks that they are going to invest in, whether it is growth based stock, whether it is a balanced stock, or it is only debt and fixed instrument stock. Mutual funds are exposed to the volatility in stock market. They are not immune to it. So mutual funds usually do well when the market is going up continuously, and it will do bad as any other stock when the market is going down. When there is a crash across the market, irrespective of how good the mutual fund manager is, even all those investments that he would have made in stocks will also go down. While mutual fund promises consistent return, it can be possible that over a period of 1 to 3 years you can still see a lot of negative return in mutual fund also. Therefore, invest in mutual fund if possible only through systematic investment plan, where you will invest some amount of money every month, because there you will be able to buy the units of the mutual fund at different set of prices and not one single high price. Instead of a lump sum investment, do make a small monthly investment in this mutual fund. Mutual funds are primarily liquid and most fund can be exited anytime. Very few have a lock-in period, else most fund can be exited whenever you want. So the risk inherent in this, you need to remember there is an entry and exit load, and mutual funds are also subjected to market risks. When the stock market doesn't do well, even your mutual fund do not do well. If you are planning for the marriage of children or the education of your children, mutual fund may not be always the best bet. You better go with other fixed type of instruments, but a portion of your income can definitely be invested in the mutual fund, so that over a period of time it builds into a good corpus. The next investment for discussion under high risk is futures and options. My sincere advice to a beginner investor is to not to get into futures and options. It is a very high risk game. Please get expertise by investing in low risk and medium risk alternatives, and then also get hands-on experience by investing in the stock market, and only then, if you have enough time, patience, ability to learn and some money to lose, only then get into futures and options, as it's a very high risk game. For the understanding purpose, let us go through what futures and option is, so that it at least builds some basic level of knowledge into you. Futures and options are financial instruments. These are also called as derivative, whose value or recognition is derived from an other underlying asset. To give you a simple example, if there is a Reliance share, a Reliance future and Reliance option is created out of that Reliance share. Futures and options are a market for speculative trading. That is, the traders here bet on the movement of price on the either side, either upwards or downwards, something similar to lottery, you can say. Based on whether the price goes upwards or downwards, the traders bet on it. Of course, there are hundreds of techniques that are used to predict whether the price is going up or price is going down. The investment that is required to trade in futures and options is significant. The option buyers can trade in it with a small amount of money, but option sellers and for futures, the investment and margin requirement are high. So therefore, unless you have substantial money, you will not be able to operate in this market. F&O trading can result either in extraordinary profits or extraordinary losses. The statistics and data proves that only a small margin of people make money, rest of them incur heavy losses in the F&O market. Therefore, unless you have significant investment in time and effort for years understanding the concept of F&O and can practically learn the tricks of the trade in the market, do not venture into futures and options. Once you have got hold of the stock market by trading in stocks, then at a later stage you may explore entering into the futures and options. Out of the three high risk options that we have discussed, stock market, that is buying of equity, dealing in mutual fund, and futures and options, you may get into stock market and mutual fund, and at a later date into futures and options. And all these three things can be done, or the investments can be made through the same demat and trading accounts that you would have with the depository participant. We are now in the super high risk investment zone. The first investment for discussion is cryptocurrency. Cryptocurrency, you can think of it as a form of digital currency that exists and is managed on the network of computers. To relate to it, today if you log into your bank account or to your investment account, you can see the savings or the investment number on the screen in a digital format. Cryptocurrency is similar to that, which exists in a digital format and not in a physical format. Crypto can be used for purchase and sale of goods and services. Eventually, it is my belief that cryptocurrency may replace the physical money. You may have heard of the RBI already testing its version of Indian rupee digital currency. Once the tests are successful, the same may be gradually released into the commercial domain. One of the well-known crypto is Bitcoin, and the Bitcoin is mined from the computer network. We need not be required to understand how the mining process works at this point in time. It is enough to know that the Bitcoins are mined from the network of computers. Crypto can be split into smaller and smaller units. Just like a rupee can be split into 100 paisa, crypto can also be split into smaller and further smaller units. Thousands of cryptos are in the market with various claimed functionalities, use and utilities, and these cryptos are listed on various cryptocurrency exchanges and traded like shares and stocks. But the biggest risk with the cryptocurrency is the valuation of the cryptocurrency is not backed by any asset. For example, if you have a value of a goods or a services, the valuation is backed based on, say, the demand and supply, or what is the cost of manufacturing that product plus a profit margin. Or if a physical currency is released by the government, that is either backed by the asset or backed by the guarantee of the government. These cryptocurrencies, which are introduced by the private sector, are not backed by any asset, exists only on the computer network and domain. Therefore, the valuation that gets assigned to it is not clear, and now it is in the realm of speculation and gambling. So the value of cryptocurrencies fluctuate very wildly. The cryptocurrency Bitcoin at some point had a zero value, had reached to $64,000 per Bitcoin, and then it has now crashed to around $26,000 per Bitcoin. So there is significant movement both up and down in cryptocurrency. It is usually traded, or in a common parlance, gambling is happening in the cryptocurrency, and therefore this investment is not for everybody. Only those who have understanding of the movement of cryptocurrency, or those who are good at technical analysis of determining how the movement happens, and those who have a lot of money to lose, only those people can get into the cryptocurrency territory. For any new investor, do not get into it. Do not venture into trading in cryptos as of now. As a woman, if you see your husband is getting into cryptocurrency, please keep an eye on him so that he doesn't lose too much amount of money in it. The next investment for discussion under the super high risk zone is the non-fungible tokens. Non-fungible means something which cannot be exchanged, or something which cannot be replicated, or something which is so unique that there is only one copy of it. NFTs, you can simply understand it as a digital image or a digital art or a picture that exists in a digital format. To give you an example, say if the signature of Mr. Amitabh Bachchan, say the first signature of Mr. Amitabh Bachchan is converted into a digital image, then it becomes a non-fungible token. We may introduce a variety of such tokens in the market or replicate in the market, but the first digital image of the signature of Amitabh Bachchan becomes unique, and therefore it carries a value. NFTs can be created and spread across art, music, video games, domain names, sports, collectible and fashion. Any of these areas can be picked up, and whatever the unique collectibles are there in such areas, it can be converted into a non-fungible token. Non-fungible tokens are also listed on the trading exchanges and can be bought and sold like any other stock in the stock market. The biggest risk that is involved here is similar to the cryptocurrency. The value of NFT is derived from its uniqueness, but again is still in the realm of speculation and gambling as to why would somebody pay a higher value for a picture or an image. But non-fungible tokens have been a craze, and they are being listed and traded on the stock markets. My sincere advice is completely stay away from NFT as of now, because it is still not clear again as to why a digital image or a digital art should have so much value, and how or why somebody would be willing to pay a much higher value for what can be easily replicated. So both the super high risk investment, cryptocurrency and non-fungible tokens are in the realm of speculation and gambling. Do not get into it unless these form of investments are structured and well regulated. We have come to the end of this course. Hope that through this course you got to understand some basic concepts of finance and got some reasonable understanding of the various investment opportunities that exist in the low risk, medium risk, high risk and super high risk domain. We would be happy to receive your feedback and inputs. Do write to us on the email provided here below. Also, please do write to us if you would want to know in greater detail on any specific topic. We would be happy to post another video on the same. Thank you for your patience and listening.